Early-stage startup valuation is like pricing a rare collectible before it is even displayed in a museum. The goal is not to guess a precise market price, but to set a reference point that helps founders raise money. Investors decide whether to invest and employees understand the worth of their stock options. Intrinsic value versus market value. Intrinsic value captures the business underlying potential technology team market size. Market value is what a buyer is willing to pay today. Objectives: 1. Determine how much capital can be raised with minimal founder dilution. 2. Provide a benchmark for future financing rounds. 3. Align incentives among founders, investors, and employees. Stakeholder perspectives. Founders care about retaining control and signaling confidence. Investors look for upside relative to risk. They want the valuation low enough that a 5 times return is achievable. Employees need a credible stock option pool that will be valuable if the company succeeds. An easy analogy: think of a startup as a sapling. Different stakeholders value the sapling differently. A gardener founder sees its future fruit. A real estate developer VC sees the land it could become. And a passerby employee only cares about the shade it gives now. The valuation process tries to capture all these views in a single number. The classic discounted cash flow model assumes you can forecast free cash flows for many years, and then discount them back to today. For a pre-revenue startup, there are no historic cash flows, so we must adapt the model. 1. Forecasting cash flows. Instead of operating cash flow, we start with projected revenue based on market size, adoption curves, and pricing assumptions. Then we subtract estimated operating expenses, research and development, sales, general and administrative, to get a burn rate. The net cash flow in early years is usually negative cash burn. 2. Terminal value. Because a startup may not have stable cash flows for 10+ years, we often use a multiple of projected EBITDA or revenue in the exit year, usually year 5 to 7. The terminal value formula. TV equals EBITDA exit times M, where M is an industry EBITDA multiple, for example 8 times. 3. Discount rate. Venture capital required returns 30 to 60% replace the typical weighted average cost of capital. The discount factor for year T is 1 plus R to the power of T, where R is the venture capital hurdle rate. 4. Putting it together. Enterprise value equals sum from T equals 1 to N of free cash flow T divided by 1 plus R to the power of T plus terminal value divided by 1 plus R to the power of N. Example: a health tech startup expects $0 revenue in year 1, $2 million in year 3, $10 million in year 5. Estimated EBITDA in year 5 is $2 million. Using a 10 times EBITDA multiple and a 40% discount rate. Present value of year 5 cash flow. $2 million divided by 1.4 to the power of 5, approximately $0.59 million. Terminal value, $2 million times 10 equals $20 million. Present value of terminal value. $20 million divided by 1.4 to the power of 5, approximately $5.9 million. Enterprise value approximately $6.5 million. This modified discounted cash flow gives a ballpark value even when the company has not yet made money. Explanation: the venture capital VC method is a shortcut that starts with the target exit value and works backwards to the present. It is widely taught in MBA programs because it ties valuation directly to the investor's required return. Step by step. 1. Estimate exit price. Forecast the company's revenue or EBITDA at the expected exit, often 5 to 7 years. Apply an industry exit multiple, for example 6 times revenue. VC funds typically require a 10 times or 1,000% return on invested capital over the holding period. Convert this to an annual hurdle rate using the formula. Open parenthesis 1 plus h close parenthesis to the power of n equals return multiple. Where h is the annual hurdle, n is the number of years, and return multiple is 10 times. Example: open parenthesis 1 plus h close parenthesis to the power of 5 equals 10, gives h equals 10 to the 1/5 power minus 1, approximately 58%. 3. Calculate post-money valuation. Divide the target exit value by open parenthesis 1 plus h close parenthesis to the power of n. V post equals exit value divided by open parenthesis, 1 plus h close parenthesis to the power of n. 4. Pre-money valuation. Subtract the new investment amount I from the post-money value. V pre equals V post minus I. Illustrative example. Forecast year 5 revenue equals $15 million. Exit multiple equals 5 times, gives exit value equals $75 million. Desired 10 times return over 5 years. Annual hurdle approximately 58%. Post-money valuation. 75 million divided by open parenthesis 1.58 close parenthesis to the power of 5 approximately equals 75 million divided by 10 equals $7.5 million. If the VC invests $2 million, pre-money valuation equals $7.5 million minus $2 million equals $5.5 million. Ownership percent for VC equals 2 million divided by 7.5 million times 100 approximately 26.7%. The VC method is simple, transparent, and aligns the valuation with the investor's upside expectations. Scorecard and risk-adjusted probability-weighted valuations are hybrid approaches that start from a benchmark, often the average pre-money valuation of comparable startups, and then adjust for the specific strengths or weaknesses of the target company. Scorecard method, think of grading a student compared to the class average. Identify key factors, team, product, market, competition, traction, etc., and assign each a weight that sums to 100%, e.g. team 30%, market 25%. For each factor, give the startup a rating relative to the average, e.g. 1.2 times for a stronger team, 0.8 times for a weaker market. Multiply the benchmark valuation B by the weighted sum of the ratings. V equals B times the sum of WI times RI. Example benchmark equals $8 million. Weights team 30% rating 1.2, market 25% rating 1.0, product 20% rating 0.9, competition 15% rating 1.1, traction 10% rating 0.8. V equals 8 million times 0.3 times 1.2 plus 0.25 times 1.0 plus 0.2 times 0.9 plus 0.15 times 1.1 plus 0.1 times 0.8 equals 8 million times 1.02, approximately $8.16 million. Result approximately $8.16 million pre-money. Risk-adjusted probability-weighted method. Similar to valuing a lottery ticket, assign a probability to each outcome: success, moderate, failure, and weight the corresponding valuations. Estimate possible exit valuations V success, V mid, V fail, and their probabilities P success, P mid, P fail. Expected value EV equals P success times V success, plus P mid times V mid plus P fail times V fail. Example success 30% chance $100 million exit, mid 50% $30 million, fail 20% $0. EV equals 0.3 times 100 plus 0.5 times 30 plus 0.2 times 0 equals 30 plus 15 equals $45 million. Discount the expected value back to present using the venture capital hurdle rate. Discount back 5 years at 50%. 45 million divided by 1.5 to the 5th power, approximately $4.1 million pre-money. Both methods let analysts incorporate qualitative judgments in a systematic way. Real options valuation treats a startup's strategic choices, for example expanding to a new market or adding a feature, as options that can be exercised later. The math comes from financial option pricing, Black-Scholes, and decision tree analysis. Identify the option. Example, a biotech startup has an option to launch a second drug after phase 2 results. The option's underlying asset is the present value of the future cash flows if the drug succeeds. Key parameters similar to Black-Scholes. S equals present value of expected cash flows if the option is exercised, for example $50 million. X equals cost to exercise the option, for example $10 million for phase 3 trials. T equals time until the decision point, for example 2 years. Sigma equals volatility of the underlying cash flow estimates, high for early stage. R equals risk-free rate, for example 4%. Black-Scholes formula for a call option. C equals S times N of D1 minus X times E to the minus RT times N of D2. Where D1 equals open parenthesis natural log of S divided by X close parenthesis plus open parenthesis R plus sigma squared over 2 close parenthesis times T, all divided by sigma times the square root of T. D2 equals D1 minus sigma times the square root of T. And N of the argument is the cumulative normal distribution. Decision tree alternative. Build a tree with branches for success or failure at each milestone, assign probabilities, and calculate expected net present value at each node. The option value is the difference between the expected net present value with the option and without it. Practical analogy. Think of a startup like a person holding a buy now or wait coupon for a concert ticket. If the concert becomes popular, high S, the coupon is valuable. If the concert is canceled, low S, the coupon is worthless. Real options valuation puts a dollar amount on that flexibility. Comparable transaction, comps, and market multiple analysis are the yardstick approach. You look at what similar startups have sold for and apply the same multiples to your target. Select peers, use criteria such as industry, stage seed or series A, geography, and revenue level. Databases like PitchBook or Crunchbase provide transaction data. Choose multiples. Common multiples for early-stage companies are EV/revenue, enterprise value to revenue, useful when earnings are negative. EV/users or EV/MAU for consumer apps. Price to sales, P/S for SaaS. Calculate median or mean multiple. Example. 5 seed stage fintech deals showed EV/revenue multiples of 8 times, 10 times, 12 times, 9 times, 11 times. Median equals 10 times. Apply to target. If the startup projects $2 million of ARR next year, implied valuation equals $2 million times 10 equals $20 million post-money. Adjust for differences, add or subtract a premium for stronger team, larger TAM, or lower cash burn. This is often done via percent adjustment rather than a full recalculation. Real-world example. A SaaS startup raising Series A expects $5 million ARR in year 2. Recent series of deals in the same niche used a median EV/ARR of 6 times. Valuation equals $5 million times 6 equals $30 million. If the startup's churn rate is half the industry average, analysts might bump the multiple by 10% to $33 million. Explanation: when a startup raises capital, each new round dilutes existing shareholders, their ownership percentage falls because more shares exist. Understanding dilution, cap table mechanics, and anti-dilution clauses is crucial for accurate valuation. 1. Simple dilution math. Suppose founders own 1 million shares 100%. A VC invests $2 million at an $8 million pre-money valuation, receiving 250,000 new shares since post-money equals $10 million. Price per share equals $10. After the raise, total shares equals 1,250,000. Founder ownership equals 1 million divided by 1,250,000 equals 80%, down 20%. 2. Ownership structure. The cap table records each class, common, preferred, and any conversion rights. Preferred shares often convert 1-to-1 to common at exit. 3. Anti-dilution provisions. Protect early investors if a later round is priced lower, a down round. 2 main types: weighted average. Most common: new conversion price equals open parenthesis A plus B close parenthesis divided by open parenthesis C plus D close parenthesis, where A equals old price times old shares, B equals new price times new shares, C equals old shares, D equals new shares. This softens dilution. Full ratchet: the conversion price resets to the lowest price paid in any subsequent round, giving early investors a larger share. 4. Example of weighted average: early investor bought 100,000 shares at $10 each. Later round: 200,000 new shares at $5 each. Old price times old shares equals 10 times 100,000 equals 1 million. New price times new shares equals 5 times 200,000 equals 1 million. New conversion price equals open parenthesis 1 million plus 1 million close parenthesis divided by open parenthesis 100,000 plus 200,000 close parenthesis equals 2 million divided by 300,000 equals $6.67. Early investor S shares now convert at $6.67, increasing their effective ownership. Understanding these mechanics lets you model how a valuation today translates into future ownership and investor returns. Explanation: sensitivity analysis, scenario planning, and Monte Carlo simulation add rigor to startup valuation by showing how the result changes when key inputs vary. Sensitivity analysis: change one variable at a time while holding others constant. Example: vary the exit multiple from 5 times to 10 times revenue, and note the effect on pre-money valuation. Present results in a tornado chart for quick visual impact. Scenario planning: build a few coherent stories, for example, base, optimistic, pessimistic. Each scenario has its own set of assumptions for revenue growth, cost structure, and exit multiple. Compute valuation for each scenario and discuss the range. Monte Carlo simulation: treat uncertain inputs as probability distributions. For example, revenue growth approximately normal 30%, 10%. Randomly draw thousands of sets of inputs, compute valuation each time, and produce a distribution of possible outcomes. Step A: define distributions for key variables: growth rate, exit multiple, discount rate. Step B: write a valuation formula, for example, venture capital method or discounted cash flow. Step C: use software Excel with @risk, Python, or R to run n equals 10,000 iterations. Step D: summarize results: mean, median, 10th percentile, 90th percentile. Interpretation: if the 10th percentile valuation is $3 million and the 90th percentile is $12 million, the investor knows the upside is large, but the downside risk is also significant. Analogy: think of a chef tasting a soup. Sensitivity analysis is like adjusting one spice at a time to see its effect. Scenario planning is trying 3 different recipes. Monte Carlo is randomly adding a blend of many spices many times to see the whole range of possible flavors. Typical question: a seed stage AI startup expects 1 million ARR in year 3. Comparable seed deals use a median EV/ARR multiple of 8 times. The venture capital firm requires a 10 times return over 5 years. Calculate the pre-money valuation and the ownership percentage the venture capital must receive for a $2 million investment. Answer: Step A: compute. Implied exit value equals 1 million times 8 equals 8 million. Answer: Step B: convert 10 times return over 5 years to an annual hurdle. 1 plus h raised to the 5th power equals 10, so h is approximately 58%. Answer: Step C: post-money valuation equals 8 million divided by 1.58 raised to the 5th power, which is approximately 0.8 million. Answer: Step D: since the venture capital invests 2 million, which is greater than the post-money valuation, the round is impossible. Therefore, the venture capital must negotiate a lower multiple or accept a larger ownership. The key insight is spotting the inconsistency. Common pitfall: forgetting to subtract the new investment when moving from post-money to pre-money. Using the wrong discount rate, mixing WACC with venture capital hurdle. Ignoring anti-dilution effects when asked to compute post-round ownership. Mixing up revenue multiples, EV/revenue, with equity multiples, price/revenue. Keep the distinction clear. Answer framework: write concise bullet points. Bullet point 1: state assumptions, multiple, hurdle rate, exit year. Bullet point 2: show formulas clearly. For example, V post equals exit divided by open parentheses 1 plus h close parentheses raised to the n. Bullet point 3: plug numbers step by step. Bullet point 4: interpret result. Is the valuation realistic? What does ownership imply? Bullet point 5: mention any adjustments, anti-dilution, option pool. Sample short answer for the above question. First point: exit value equals 8 million, ARR times 8 times. Second point: annual hurdle is 58%. Discount factor for 5 years is 1.58 raised to the 5th power, approximately 10. Third point: post-money valuation equals 8 million divided by 10 equals 0.8 million. Fourth point: required investment 2 million exceeds the post-money valuation. indicating the venture capital would need approximately 100% ownership or the terms must be renegotiated. Therefore, the proposed $2 million for a standard seed round is not feasible under the given assumptions. Using this structured approach helps you earn marks for both calculation accuracy and logical reasoning.